Hello. In this third session, what we're going to focus on is looking at the performance of the organisation, looking at their financial statements. And so this covers, in terms of the assessment support sheet that I've created, it's the section entitled Financial Performance. So we're covering Learning Outcome 3 today, which is looking at financial data, information and accounting systems. And we're looking at them in terms of how do they fit or how do they contribute to the organisation's objectives. Now, in our previous sessions, you've mentioned that actually sometimes in the annual report, they don't talk much about the future. Instead, it's all about historically what's happened. So we're going to have to try and align what we're finding with how on track they are with where they want to be. So from the assessment, it actually says we're looking at different types of financial statements. So this is what we're looking at today, the profit and loss, the balance sheet and the cash flow. But we also need to put a little bit more context around it in terms of accounting concepts and frameworks in using them. So what I've suggested is that this section totals around 500 words, which isn't a huge amount, but we can put some of it in tables. And I've suggested that we start off here by looking at the role of financial statements and how they all sort of come together to give us a picture. I've suggested you pull out relevant accounting concepts. So you might see some of these mentioned in their financial statement, and if so, those are the ones you want to use. So I'd rather, if you can, to try and keep this section quite specific to your organisation, because there is a risk that this could be quite descriptive in terms of explaining what the going concern is and this, that and the other, but actually what we want to know is how is that then relevant to your organisation and what does that mean? So just in terms of starting off this section on financial statements, when it comes to financial performance, there are three branches in terms of different types of accounting. So we've got our financial accounting, which is where we're sort of almost to help us run the business in terms of like the financial transactions. So here we're recording sales and costs. So we're doing things over a set period of time. We're looking at what's coming in and what we're spending. And we consolidate all that to make the profit and loss statement. And we're summarising at the end of it, we'll be summarising what we own, our assets, and what we owe, our liabilities. And we'll also be recording what capital we've got, so in other words, any machinery that we've got. All these come together in the balance sheet where we're looking at the ins and outs of the business. So that's our financial accounting. Now, our management accounting is looking at like how we create our budgets. It's looking at how we actually cost out our products and services. So with this one, this is where we'll be looking at doing sort of more management accounting in the next assessment, where we're costing out delivering a new product or service. So without working out the costs, we don't know that we're actually going to make a profit on them. With management accounting as well, we need to calculate budgets. So again, we're looking forward at like actually what we're anticipating, what are the costs involved. So I think when I did my introduction exercise with you, I was asking about if you personally budgeted. So it would be the same sort of process that an organisation would go through, obviously a lot more robust with an agreed method in terms of how they produce those budgets. And then financial management, the final branch, if you like, of these sort of types of accounting, that's where we're looking at actually the control measures that we're putting into place here. So we're considering how we are sort of managing it on a day-to-day basis. So where are we getting our money from? Looking ahead, is there going to be a shortfall? If so, what options have we got? What's our cash position look like? So it's just making sure, it sounds a bit basic, but that we're staying in business, that we are able to have this sort of idea of cash being king, that we've got sufficient money in the business to fulfill our growth potential and our grand plans. So I've put here's the narrative around what I've just said in terms of like the three different branches. And actually you may want to talk about how the financial statements relate to this, but obviously you can look at the slides afterwards and work out where each one goes. And I've related them to our examples in the videos that I've shown you that I've had produced and the animations. So the next thing that I think is going to be quite useful to at least consider, and again, I don't want you just reciting these, but I want you to think about how do they actually work for your organisation and what benefits do they give, or sort of, you know, why is it useful to do this? Okay, so when it comes to accounting and sorting out the finances for an organisation, right, we've got to have some assumptions, because without these we can't make any plans. And so here are the assumptions that are sort of uniform and they're standard in terms of what all organisations in the UK at least follow. And they are also supported by the guidance, the regulations that we've started to consider and I've asked you to look at in their statements. So the key underlying concept is this idea of a going concern. Okay, and what I mean by that is that the organisation intends to continue trading. And if it doesn't, this needs to be very, very clearly stated. So the idea is that for the foreseeable future, the business will continue to operate. And so that's like the whole basis of producing the accounts. If it's just meant as almost like asset stripping, so they're selling things off and they're doing it and then planning to wind down the business, they cannot produce the accounts with that base as the basis unless that's very clearly stated that the business intends being wound up. Okay, so the other ones that support this going concern include the accruals concept. Okay, so the accruals means that the revenue and costs are recognised as they go along, as they are earned, and not as cash is received or paid. So what I mean by that, so I'll relate it to my small limited company. When at my year end, what the accountant is looking for is the invoices that I've issued. Okay, so these are the ones that will be accrued rather than the ones that I've actually received. So I might have at the end of a year, if I've just issued a couple of invoices that haven't yet been paid, they will be seen as debts that are owed to the business. So the accruals is based on when the transactions happen, in terms of like raising invoices, raising purchase orders, whatever that might be, rather than when the money's actually received. So obviously there's a concern there that actually sometimes that might not happen. So you might have what's called bad debt. So where you think you're going to secure some money, but that's actually not the case. It never comes in. So the next one we've got in here is the business entity concept. So that is that the business's activities are based on what the business aims to deliver rather than the individuals owning it. So it's sort of the business is not just like a sole trader where it is the individual. The business is a separate entity to those individuals. Okay, and the economic activities are based around the need for that business or the aims and objectives of that business. So money measure concept is that transactions are recognised in financial statements. They're only recognised if they can be measured financially. So if I were to win a business award, which actually have won quite a few business awards in the past, one of the business awards, which wasn't one I won, but a recent one in my area, one of the prizes was advertising on a bin lorry, which was quite a prize really. Anyway, that has no financial value because there's nothing that you'll get. Well, it potentially has a value, but it's not a value that could be captured on a financial statement because it's given at no cost. So in terms of the money measure concept, that benefit would not be logged. So if I am doing some mentoring to one of my friends on her business, and in exchange she's supporting me in my business in a particular way, again, they're trading off. So actually there is no financial exchange there, and therefore there is no money measurement in place. Okay, so the next one we're looking at is the materiality concept. So this is that only things that are really relevant in terms of material items of information are included in the statements. So it could be it's sort of if it's useful, if it's going to be helpful to see the picture. If it's immaterial, then it doesn't have to be included. But actually, most things are material. So the idea here is that you can't leave stuff out that's important. So you can't decide because that information isn't helpful that you're not going to include it. Historical cost concept. So this is the principle that the values of the organisation are based on their original acquisition cost. So actually, now this is a tricky one, because obviously sometimes it might need to be readjusted or revalued, but if it does, it needs to be done in a fair way, and this needs to be stated. But unless otherwise stated, everything is based at what it cost when it was bought. But we'll look today at something called depreciation, which shows actually how you can adjust this to take into account that the value will change in time. Consistency concept. So here we're looking at this idea that every accounting period we're using the same principles, because otherwise we can be changing things a bit, we can be revaluing things, so we can always look like we're doing really well, whereas actually the reality is some of the decisions we make now, if there's an element of risk, may actually mean they don't pay off. But if we're consistent in how we perform, how we deliver and produce our financial statements, then that means that there's an element of trust that's built there in terms of being accurate and being comparable from period to period. A period being the accounting period, so that might be 3 months. I mean, for a financial statement, it will be 12 months, but they might also be reported in quarters. The prudence concept. So this is the principle that money and profits are only included if there is reasonable certainty that they're going to be received. So going back to this idea here of the accruals concept. So I've issued an invoice. If I know that business I've issued the invoice to is going to go under, I cannot include that and say that money's going to come in, because the prudent concept says that actually, if there's no certainty that that's going to come in, I need to write it off. So it makes sound decision making. So all of these are a way of sort of almost, if we've got this situation, how do we deal with it? So maybe in your financial statements, just have a scan through this and have a look. Have a look through their financial statements and see if there's any mention of any of these, and explain how you think they're useful in terms of the consistency, in terms of producing information. But bear in mind, this financial information isn't just produced for the sake of it. It actually should be the basis of making decisions, both internally and externally, and helping inform stakeholders. So moving on to our types of financial statements. We've got the purpose of having these financial statements is that we can see how money's moving around the cash. We can see where money's coming from, so how much income was coming in as well. We can see ultimately how much does a business has it accrued in terms of profits, how much has it lost. So it's a really good way of understanding the performance of the organisation. And what I really like is that it's compared over time periods, generally 1 year to the next. So therefore we've got a benchmark already to see how's it compared year on year. So we've got 3 financial statements. We've got our balance sheet, which is where we're looking at what's coming in, what's going out, how the business is funded, and what assets has it got. So what the good stuff, and the liabilities, so the stuff it owes, and how that balances out, and what the extra or what the debt is on that actually, and how that's funded. So we're looking at a sort of an equilibrium. We've got the income statement, which is the money coming, the profit and loss. So this is used to calculate the dividends, and also used to calculate the corporation tax as well. So this is quite one of real interest, actually, the profit and loss, but it's historic. And then we've got the cash flow, which looks forward. And this isn't a formal requirement from HMRC, so the government, but it may be if your company is floated on the FTSE, I'm not sure. But this is like a management planning tool, so we can look at what's due to come in, what's due to go out. If we're growing, we need more cash because we're going to have to fund paying for this growth. So that's why that one's really important. And then this is from week 1. So I've already talked about this, but this just compares the 3 statements, and it looks at the balance sheet being currently what's going on, the ups and downs of the business, so what it owes and how it's funded and its assets. So that's quite a good picture of where we are at now. The cash flow looks ahead, so obviously there's no certainty there, and records what's going in, what's going out, or it could be historically looking what's going in, what's going out, but generally it's used to plan ahead. And the profit and loss is one that gives us an indication of what levels of profit we've got, what levels of tax we owe. So it's looking historically at the performance in the past year. So have a look at this in depth as well, because the idea with these slides and the idea of introducing this section is really the jigsaw that these three financial statements provide in terms of looking at the financial performance. And that's what I want you to do in the beginning section of this report. Not for very long, you have not got very many words, but is to explain the picture that's created by using these financial statements and analysing them, and also the basis and the assumptions that are used to make them as well. And you're going to tailor this to your particular organisation. Okay, so hopefully that's a good starting point for just setting the scene in terms of the financial statements.